joining me today. I appreciate you being here. Today, going to be looking at a term sheet that I got from Vizio Lending for a property that I have, a 3-bedroom, 2-bath that I need to get out of a fix and flip loan into a long-term loan. So I got some terms here from them that are going to take a look at here. Um, uh, I paid, as you can see here, $159.5 for the property, and of course, to get the term sheet, I provided them all the pertinent information that they needed to be able to come up with these numbers. But I paid $159, and if you want to know what that is, just ask. Just put a comment down there, and I'll be glad to provide some information in regards to the specifics that lenders can ask to create terms for you. I paid $159.5. Estimated value is $240. It hasn't been appraised. That's just the estimated value. Loan to value 66.46%. Interest rate 6.97. This is an adjustable rate quote, 5-year adjustable rate quote. Won't find out the rate until actually do the loan and get the actual terms. So don't know what that rate would be, but arms scare me as they would with conventional loans. This would be a DSCR loan. Within the DSCR has a 1.25 DSCR score. That's basically the DSCR is basically indicates the ability of the rent to be able to pay back the loan. So the higher that number, the better. So yeah, 1.25 is well within guidelines that most lenders look for. They like one, at least one. Some will go below one, but they like one or higher. And so this is a good number. And so basically, when we look at the terms of this, with this interest rate, and let me say this also, the prepay term is 3 years. Most people just give you 5 years as a standard, but they started with 3 years. And the prepayment indicator is how long before they punish you, I guess, is for lack of a better word. If you sell within the first 3 years, then there's going to be a fee to do that because they want to make their money with doing the loan. So after 3 years, then you could sell it without that penalty. But if you sell within the first 3 years, then you have to pay a percentage of the loan amount as a penalty. So you can make this number even lower, but that typically will raise your interest rate. So they can do a 2-year prepayment penalty, a 1 year, but it'll raise your interest rate, which will in turn raise your payment. So this can be adjustable, but most lenders that I get terms from will use 5 years there. So, but this one's 3, and so that brings, we come down here and it shows what the payment could be. So the principal and interest is $1,058 a month, and this is the loan amount. I should have said that first. This is the loan amount. So I refinance out of the fix and flip loan into the long-term DSCR loan and finance this amount, and the payment will be this, principal and interest, and then you add in taxes and insurance to this amount here, and that gives you a payment of this $1,278.48. Now, my monthly rent, estimated rent, is $1,600. So we subtract $1,600, which is the rent, from the loan payment, and it gives cash flow of $321. Now you need to have capital expenditures and other things come out there, vacancies, repairs come out of that amount. So you shouldn't be putting this entire amount in your pocket. A percentage of that should be going for vacancies, capital expenditures, repairs, those items. And if you're doing property management, that would come out of that as well. So this isn't the amount that goes in your pocket. That it'll be less than that. So just keep that in mind. That's your cash flow, but you have things that need to come out of that. So uh, that needs to be taken in consideration. So what I'm doing is I'm looking at all these term sheets from the various lenders and comparing them, interest rates, and all the specific terms and fees to determine what is the best option for me. Now, for me, I'm not doing a cash out refi. I'm not pulling money out uh, of this deal. I'm just doing the refi. Depending on the amount of the spread between the value and the loan amount, you could do that. Uh, but I'm not doing that in this scenario. I'm just doing a new loan at the lower interest rate because I'm paying now 11.5% for my fix and flip loan. So that's a significant drop to go from that down to the interest rates of the DSCR, which is in this range, in the seven, and more realistically, these are going to be 7 to 7.5. This is a little lower than most you'll see, but 7 to 7.5 is more typical right now. But that's significantly lower than 11.5. So that's the reason for you want to get out of that fix and flip loan. You want to get away from that 11.5%. You want to get down into the low sevens or lower if possible. But that's the goal because this is going to be a long-term loan, 30 years. Uh, and also, there are 40-year DSCR loans, but I've checked into those, and those typically don't really lower your payment hardly anything. You'll have 30 years, and then you'll have an additional 10 years for a 40-year loan, and then that's going to be an interest-only period. So you're not going to be building any equity on that 40-year loan for the first 10 years. Now, if I'm going to do that, I want that payment to be really low, and I'm not finding that it's really lowering the payment to justify doing that, because all you're doing is just paying them interest for 10 years and you're not getting a significantly lower payment. So I'm just not seeing any value in doing the 40-year, although it's available. You know, a payment being less by extra $20 is not worth 10 years of interest payments to a lender. So that's why I'm sticking with the 30-year loan for the DSCR. But this is basically what I do. I just get these term sheets back, and then I just look at the numbers, look at the payments, the interest rates, the prepayments, you know, if there's an ARM included in there, and just compare the different lenders and see which ones feel like that is an ideal fit for a loan. And you can always refi again later if you choose to. So you're not, once you pick one, you're not stuck in that for 30 years. You can always refi uh, at a later time, especially if interest rates drop. So don't feel you're stuck if you make a selection here. It's not forever. But that's how I analyze. I just basically look at, you know, what the interest rate is, the prepayment penalty is, because that's important in case, because you never know when you might need to sell the property. You may need to sell the property, you know, sooner than you realize, and you want to know how much that could possibly cost you to do that. So that's important, figuring that. And then, of course, the payment, depending on, you know, if you want a cash flow, how much you want a cash flow, you need to know that payment. And comparing all those, you know, factors are very important in making a decision on the loan. So hopefully my interpretation of looking at a term sheet has helped you in some way. If you have any questions, feel free to ask. I'll be glad to answer any question I can. Thanks for watching.